Imagine waking up on a Monday morning to discover that your retirement account, the house you spent 30 years paying for, and the very foundation of the American economy had been set on fire by a handful of men in tailored suits. On September 15th, 2008, the impossible happened. Lehman Brothers, a 164-year-old titan that had survived the Civil War, 2 World Wars, and the Great Depression, vanished in a single heartbeat. This wasn't just a corporate bankruptcy. It was a $600 billion explosion that sent a shockwave across the planet, vaporizing the life savings of millions and pushing the global financial system to the very edge of a total, irreversible collapse. For those over 50, the images are burned into memory. The dazed traders walking out of glass towers carrying cardboard boxes, the frantic news tickers on every screen, and the sudden, terrifying realization that the too big to fail era had just ended with a catastrophic thud. Today, we go behind the mahogany doors and into the secret meetings of that final desperate weekend to uncover how a century of prestige was dismantled by a toxic cocktail of mathematical arrogance, shadow accounting, and the monumental ego of a man they called the gorilla. To truly understand the magnitude of this fall, we have to revisit the early 2000s, an era of financial euphoria that feels like a fever dream in hindsight. Wall Street was no longer just a place to trade stocks. It had become a global mint where complex debt was transformed into pure gold. American investment banks were aggressively expanding their reach into the booming markets of Singapore and Hong Kong, fueled by a process known as securitization. The logic was dangerously simple. Interest rates were low. The government was pushing for the democratization of credit, and the prevailing wisdom was that home prices were a one-way bet that could never go down. Banks began a relentless cycle of originating mortgages, often for people with no proof of income, and selling them to houses like Lehman Brothers. These debts were then repackaged into opaque products called collateralized debt obligations, or CDOs, and sold to the world as low-risk investments. It was a cathedral of wealth built on a foundation of quicksand, and at the center of the machine stood the 4th largest investment bank in the United States, convinced it was invincible. The face of this empire belonged to Richard Dick, Jr., a man whose leadership style was so aggressive and physically imposing that his peers on the street nicknamed him the Gorilla, a former commercial paper trader who fought his way to the top. Fuld didn't just run Lehman Brothers. He personified its cutthroat culture where dissent was silenced and risk was rewarded with 9-figure bonuses. By the mid-2000s, while competitors like Goldman Sachs were beginning to smell smoke in the housing market, Fuld doubled down, convinced he could out-hustle the entire world economy. Under his watch, the firm became leveraged to a suicidal degree, borrowing nearly $44 for every single dollar of real capital it actually owned. This meant that if the value of their mortgage-backed assets dropped by a mere 3%, the entire bank would be insolvent. It wasn't a business strategy. It was a high-stakes gambling addiction masquerading as sophisticated finance, fueled by a leader who believed that Lehman's 164-year history made it immune to the laws of gravity. The first major cracks appeared in 2007 as the liar loans began to default at an alarming rate, and by March 2008, the world watched in stunned silence as the first major domino, Bear Stearns, collapsed. However, the Federal Reserve intervened, facilitating a government-backed buyout by J.P. Morgan, which ironically created a false sense of security inside Lehman's 7th Avenue headquarters. Dick Fuld and his inner circle remained in deep denial, even as the bank reported a staggering $2.8 billion quarterly loss in June 2008, its first in 14 years. Desperate to maintain the illusion of health, Lehman began using a controversial accounting gimmick known as Repo 105. This allowed them to temporarily shift $50 billion of debt off their balance sheets just before reporting to the public, only to bring it back days later. It was a high-stakes shell game designed to window dress a burning house, misleading investors and regulators alike, while the core of the bank was rotting from the inside out. The situation reached its breaking point on Friday, September 12, 2008, when the New York Federal Reserve summoned the CEOs of Wall Street's biggest banks to an emergency weekend summit. Treasury Secretary Hank Paulson delivered a blunt ultimatum: find a private buyer for Lehman Brothers because there would be no taxpayer-funded rescue this time. Paulson was haunted by the concept of moral hazard, the fear that if the government always saved the banks, they would never stop taking reckless risks. The atmosphere was surreal as regulators munching on sandwiches and taking catnaps on leather sofas watched potential deals with Bank of America and the British giant Barclays fall apart. Bank of America pivoted at the last second to buy Merrill Lynch instead, and UK regulators blocked the Barclays deal, refusing to let them import America's toxic waste. Dick Fuld sat in his office, reportedly waiting for a phone call from the government that never came. And at 1:45 a.m. on Monday morning, the largest bankruptcy in human history became official. While the media focused on the immediate carnage in Lower Manhattan, the human cost was devastatingly global, hitting everyday people far from the trading floors. In Singapore and Hong Kong, retirees who didn't speak English well had been sold mini-bonds and high notes that their local banks claimed were as safe as a fixed deposit. When Lehman collapsed, these structured products became worthless overnight, and there are heart-wrenching reports of elderly investors suffering heart attacks in bank lobbies upon realizing their life savings had vanished into thin air. Back in the States, the Dow Jones plummeted 500 points in a single day, and the global markets eventually lost $10 trillion in value. In the aftermath, Dick Fuld was called before Congress to answer for the $300 to $500 million in compensation he kept while his bank imploded and the world economy tanked. His only defense was that the system failed. He walked away a wealthy man while a generation of Americans was left to pick up the pieces of a ruined economy. Today, the name Lehman Brothers is a ghost in the history books. A $600 billion reminder that no matter how high you build your tower, if the foundation is made of ego and debt, gravity always wins.